One of Australia's property behemoth companies, Domain, has come out with their end of year 2023 wrap and the key trends for 2024. It's not all positive. We're going to go through deep dive into exactly what the report says, my thoughts on it, and where they've got it right and where they've got it wrong. What is going to happen to the property market in 2024? We're going to cover 3 downside factors that may suppress the market in 2024. These include inflation remaining too high, driving the cost of goods up, unemployment going up, and potentially a fall in incomes as a result. And the main one, affordability being so tight, the worst in 50 years in many capitals, particularly in Sydney. We're also going to cover 5 key trends that may appear in 2024. We're going to deep dive into Domain, Domain's end of year wrap, and uncover their own thoughts to give you insights about how to invest in property, where to look, and what you should be thinking about when assessing the market. We're going to cover 3 positive themes. Supply levels being so contained in the same time where population growth rates are so high. We're going to uncover how lending may change in 2024 that positively impacts people's borrowing power after years of negative impacts to borrowing capacities from higher interest rates. If you're interested, hit that subscribe button, hit that follow button. Hi, I'm Reedham Sayed, founder of Confidence Finance, 6 times top 100 mortgage broker here in Australia, and avid property investor. This is the house and unit price forecast in 2024. Look at what you can see here. It is pretty dense. And the thing I love about this Domain report is it's not doing a demand supply level analysis, a nitty gritty micro analysis, and then drawing up conclusions from there. That's what SQM did, driving their house price forecast. Domain, on the other hand, have so much qualitative data, the best in the industry. It has what everyone is searching for. And from there, it can pick up trends as to what they think is going to happen to the property market based on what is happening right now and what people are searching for. Interestingly, when you look at Sydney here, Sydney is the market that's doing the best according to Domain in 2024. You've got Adelaide also doing really well, 7 to 8% growth in both, Sydney and Adelaide. Really strong growth factors here. You also have Brisbane doing really well, 7 to 8% there again. And Perth doing exceptionally well at 6 to 7%. If you look at it, it's pretty uniform across some of these major capitals. 6 to 8% seems to be the number in Sydney, Adelaide, Perth, and Brisbane, with Canberra being a little bit below that, Melbourne being a little bit below that, and some of the big regionals, Gold Coast, Sunshine Coast, a little bit below that. How much of this comes true? Don't know. It's very wishy-washy to make 2024 forecast. It also seems way too uniform to me. I really expect there to be pretty big differences in capital growth rates between cities. We've done a couple videos on Sydney, both the affordability drag and also the upside factors that are really driving the Sydney market. And we've also done a podcast on Perth, showing really strong data metrics, and unpack the state of state reports too to showcase how each economy is performing. This is the number one positive factor that I look at. When you look at this chart, the undersupply, oversupply over periods of time, what Domain have done is they've simply got a proxy for demand by using population growth rates. More people come in, more people demand homes. Now, if you look at this, we were in oversupply during the COVID period, and now we're in undersupply. But if you look at it, more recently, population growth rates are starting to trend back down. We are still well into an undersupply category as of right now, but we're in an oversupply period for a number of years during the COVID period, 2020 to 2022. So it should fairly evenly balance out when you kind of look at this, big V-shape down, upside down V coming up. So this in itself doesn't look that concerning, but it actually is, because we're currently in an undersupply and there's no stock of homes available. When you look at rental vacancy rates, they are plummeting down. When you look at the total stock of sales that are happening all across the country, the total stock on market figures, that's pretty low across many capitals as well, while buyer demand is high. And that's why prices have been rising, particularly in Sydney in 2023, and other capitals like Brisbane and Perth have been shooting the lights out recently because of this undersupply that's really apparent. So let's get into the three upside factors. We're talking about two of them right here, right now. Population growth remaining really high, undersupply of dwellings being apparent at the moment, and no stock of homes available. Domain's third factor is relaxed lending standards. This one I love talking about, and it's very, very interesting that Domain are predicting lending standards to relax through 2024. So what they're saying is this 3% serviceability buffer that we apply on may actually change. It may get reduced. Now, I genuinely believe that APRA are willing to change this down, but won't do it when inflation is too high, and are looking at this periodically every 3 months to see if the data allows them to change. The data itself does showcase that they can reduce the serviceability buffer because the debt to income ratios of new mortgage lending have plummeted down. The reason for that is no one can get a high debt to income ratio anymore because serviceability caps are so high. You simply can't borrow enough money when you go to a bank to get a DTI above 6 anymore. So the metrics that they're using are showcasing that there is no high risk lending anymore in that sense. What that simply shows is loans being written today are really high quality. If you can meet serviceability benchmarks today, it means that you're meeting these serviceability benchmarks at like 7.5%, 8%, 9% assessment rates. And if you could do that, you're probably a real quality borrower. What Domain are predicting is there could be upward revisions to borrowing capacity. We've done some modeling here. A 1% change in the assessment buffer will lead to a 10% improvement in your borrowing capacity. And you do that on aggregate, it could push up prices. Furthermore, if there's rate cuts, that could be a further driver, but it is a potential upward price driver, particularly in the back half of 2024. And it can be a real step change, and it really does impact the Sydney property market a lot. And it could be why Domain have such a strong Sydney property price prediction in 2024. Now, if we go on the flip side and look at the downside drivers, rising unemployment, I think that's the main one. I've touched on this in other videos, is if the employment market continues to deteriorate and happens to deteriorate a little bit quicker, what you can find is fewer people are in jobs, total employment numbers may come down, and that could cause pressure on individual housing markets. This one is really going to be state by state, employment market by employment market. If one employment market holds up pretty well, then you'll find that that property market is going to do better than other property markets, all else equal. Meanwhile, in Sydney in particular, as a financial hub, if the employment market weakens, then property prices may be a little bit too strong for the current valuation levels. You'll also find population growth starts coming down if unemployment starts going up. Those two are correlated because a strong employment market drives people in from all around the world to come and work in Australia. So those two can be really correlated, which makes unemployment one of the key metrics to look at in 2024. You've also got inflation. Inflation being too high reduces people's purchasing power, continues to erode living standards, and can keep interest rates really high for longer. It will also mean no more relaxed lending if inflation is simply too high. They won't start giving out people bigger loans and more money into the system when inflation is way too high. It just doesn't make sense to do that. And the main reason why property prices are kind of capped, the growth levels are kind of capped, instead of seeing 20, 30% growth levels that you've seen in 2016, 2019, and the growth projections are fairly modest across most of the capitals. Perth doesn't have this restraint as much, but across most of the capitals, you see, single-digit growth forecasts across most housing economist predictions. The reason for that is affordability is so contained at the moment. The rent or buy equation in each state is a bit nasty. It's cheaper to rent than buy. The percentage of income going to mortgage payments is exceptionally high. We've touched on that a little bit as well. So those are the main downside factors. So there you have it. A little bit of a summary of what Domain think, some upward price drivers and some downward price drivers. Let's get into what are people actually searching for. I loved looking at this one because wherever you go across each individual state, Domain data shows that everyone wants a pool. That seems to be the number one search criteria across Domain everywhere in every capital and across the national housing market too. Pool is the number one searched item. You also see an increase in demand for studies, so an extra bedroom or a study location, as people now work from home in a more sustained manner. So they may not need an extra bedroom for affordability reasons, but they do need a space to be able to study and work from home. You also have other factors that they look for. Things like granny flats are becoming really, really popular. That could be because people want to find a way to make their mortgage payments, and granny flat income is really, really powerful. Or it could just be co-sharing of housing, in-laws, grandparents, etc., to make housing affordability work. You could see the average number of people in each dwelling increase. And if you do that, you're going to show some management of housing affordability issues by simply having more people in each home. That's one way to solve the housing affordability crisis. So that's what people are looking for. Another interesting comment here is beach popularity has definitely fallen. Perhaps that's because people have been priced out. You don't see house prices around beach areas being low. They're really, really high, and maybe people have just given up on the ability to do that when interest rates are so high. So some of people's search criteria are actually driven by what their budget is, and people have to make a sacrifice somewhere. They still want the pool, but they'll be willing to give up the beach. Really interesting one. So let's go through 5 key things that Domain see in 2024. I found this part of their report really, really interesting. 5 key themes, trends to look out for. 1, an interest rate cut will spark demand. Domain really believe that if interest rates begin to fall, and if there's just one cut, that affordability will start to improve. Those are facts. But it's going to create sentiment change. It's going to create a powerful force, motivation among so many people sitting out there on the sidelines, afraid, scared to act. It's going to bring them into the market and say, interest rates are now falling. We are in a cutting cycle. It might bring investors back into the market in a herd-like mentality if interest rates begin to fall. That could happen across the national property market, particularly in Sydney and Melbourne, where interest rates are a real container on market dynamics, particularly at the moment where borrowing capacities are so weak. Remember, each rate cut around 25 bips improves borrowing power by 2.5%. So 4 rate cuts or a percentage point cut in interest rates will lead to roughly a 10% improvement in borrowing power. And likewise, 1% drop in the assessment rate will improve borrowing powers by about 10%. So those are 2 factors that could combine together that lead to better lending conditions in 2024. I really do expect that. I'm not so sure whether it's going to be 2024 that we see better lending conditions or 2025, but I do expect better lending conditions because we are currently in the tightest financial conditions I have ever seen, and Australia has operated in for at least a decade. Borrowing capacity is really, really low, high repayments, high house prices, affordability stretched, high percentage of income going to housing costs. You have the worst financial conditions in a long time. So you could see that the market's performing pretty well with these conditions. So when these conditions start to reverse, you may have an influx of demand. And if it does happen, I agree with them. It's going to really support house prices all across the country. The second one that they have, and I love this one too, is the flight to affordability. I think this is a 2023 trend, actually. It's happening right now. All of these tight financial conditions is forcing people to look for affordability. We see this all the time. In my local area, for example, we've met a few people at my daughter's childcare, and we've met a couple of them who are saying the same thing. They're simply moving areas because they want to buy a home in an affordable location. And buying in Sydney is really, really difficult. So you have people moving to these regional capitals, regional areas that are a little bit cheaper. So the flight to affordability is going to be a big driver and big motivation in 2024, according to Domain. I'm going to change this around and say it's already happened. It's happened in 2023, and it will continue in 2024 as long as this high rate environment continues. This one was really interesting. They've got YIMBYs will replace NIMBYs. What that means is yes, in my backyard versus no, not in my backyard. With housing affordability really, really crunched and housing crisis here in Australia, where supply levels are so low relative to demand, and we're simply not building enough homes, the motivation to change how a location actually is and change planning rules, rezonings, state-based rezonings, whatever it is, to get more homes in to existing areas, people are going to become more supportive of this. I have no idea if this is going to be true or not. I'm not so sure because people don't want overdevelopment where they are. especially in particular existing locations where they live. So I'm not so sure that NIMBYs is going to change into YIMBYs, but they've got it as a housing trend. And in my opinion, it's a necessary one. And we really, really need to take the country with us to ensure that change can happen where change is required. And we can get more people to live in the areas where more people should live, particularly around transport hubs in Sydney. And that's what YIMBYs will require. I recall in one area where I was looking in the inner south of Sydney, where they proposed a potential planning change. They simply highlighted as a location. They had community opposition so strong. I went to a community session and it was flooded with people. It was a huge protest from people saying, not in my backyard. The contesting of population growth go higher and higher. People want their areas to remain the same. And instead of saying, yes, in my backyard, they're going to say, no, stop having such a problem in the first place. And instead of solving the housing affordability crisis by building more dwellings, perhaps we should simply take less people in. I think that may be a trend. Domain probably wouldn't say that one though. Fourth trend, population-driven housing demand. Strong population growth, they think it's going to remain. I do too. If the economy needs it, the government will promote it. And if that's the case, then you're likely going to see actual population growth remaining really high. Even if the people don't want it so much, it's still going to remain really, really high. And as a result, housing demand is going to be driven by population growth. That may mean more demand for apartments in 2024 versus houses, because new entrants to the country are probably more willing to live in apartments than to live in houses. We've got issue number 5 that they've raised, rental markets reaching a tipping point. House prices are so high, the rental price inflation is so high that it's going to cause a little bit of a shakeup, and we're going to hit a tipping point, and we're going to start hitting more of a balanced market in the rental market. The reason for this is people are going to start congregating, and the number of people living in each dwelling is going to rise as a result of all the affordability issues, and it's going to put less pressure on the rental market in 2024. We're also going to see high mortgage stress and investors starting to divest their portfolios, particularly those that have poor cash flows. So you might expect to see that more in Melbourne, in Sydney, potentially a little bit in Brisbane as well. You're going to see more investors sell out, and that for some reason is going to help reach a more balanced rental market. I'm not too sure how they've worked that one out, but they do think the rental market's going to get closer to equilibrium and stop rising so much in terms of prices as a result. There you have it. Domain's end-of-year property wrap in 2023. Let's summarize again. Year-on-year price growth in some of these capitals, really, really strong, 7 to 9% across most major capitals. Domain's end-of-year prediction.